Chapter 20, Accounting Changes and Errors. Now, when we look at accounting changes, we have different types, and based on the type is a general approach toward how you're supposed to account for them. Now, number one is if there is a change in accounting principle. And this means that you're changing from one generally accepted accounting principle to another. An example would be adopt a new accounting standard. Another would be you're changing methods of inventory, and that really depends on which direction you go, how you handle it, and then change from the cost method to the equity method or vice versa. What they're talking about there is if you buy another company's stock and you increase your ownership in that company's stock, it may affect how you account for it. Now, we also have what we call a change in accounting estimate. This is when we revise an estimate because of new information or new experience. Examples would be change depreciation methods. Now, here's the thing to remember, is a change in depreciation method is also considered a change in estimate that achieved by a change in accounting principle, but we treat it as a change in estimate which we only look at it forward. We would have changes like, for instance, if you decide your warranty reserve is too high, or your allowance for doubtful is too high, or you estimate, any type of changes where, another would be is you have estimated a loss. And there are certain rules, and that would also be an example, because maybe you estimate it'll be a $100,000 loss, and maybe you actually have a $50,000 loss. That would be a change in estimate. And then we have a change in reporting entity. Change from reporting as one type of entity to another. This would be if you were to go from consolidated returns to not consolidated returns. Now, what does that mean? You learn about that really in advanced accounting and a little bit in this chapter. Is that when you do consolidated financials, what it means is that you own more than 50% of another company's stock. GAAP requires that you roll their financials into the parents. Now, this is not done on the books, it's done on working papers, and so what you end up doing is you treat the subsidiary and the parent as if they're one company. Now, the subsidiary just does their regular financials. It's only the parent that has to do this. And that's why if you look at any financial statements and they say consolidated financials, what that means is they have included other companies' financials in theirs where they owe 50% or more, or greater than 50% or more of another company's stock. Now, another is, what happens if we have a mistake? This is a correction, an error caused by a transaction being recorded incorrectly or not at all. Could be because of the mathematics, maybe you just put something in the wrong period, something was expensed or capitalized when it shouldn't be, and of course worse is there's fraud or just somebody just didn't know what they were doing. Now, reporting changes and error correction. There's three approaches. We focus primarily on retrospective, which means you have to go back and change things. So, financial statements issued in previous years have to be revised. Statements are made to appear as if the newly adopted accounting method or whatever you've done all along or that the error had never occurred. And then a journal entry is created to adjust all account balances affected. Now, a modified retrospective approach. This is done when you're going from one inventory valuation to another. There's one, I think it's from FIFO to LIFO, one or the other, where it's really not possible for you to go and figure out what's going on. Or if they enact a new accounting change in the current year. Here's what they're saying, is that the standard is only applied to the current period. You adjust beginning retained earnings. Now, the prospective approach is done whenever you have a change in estimate. The effects of a change are reflected in the financial statements of only the current and future years. Now, here's a little summary for you. Let's start with a change in accounting principle. Remember, in most cases, you have to go back and change. You have to restate prior years. The cumulative effect has to be shown as an adjustment to beginning retained earnings, and the journal entry has to be made to adjust balances, and you must have a disclosure note. Change in accounting principle. This is again as if we adopt a new accounting principle only for the current year, or if we change from LIFO, if we go to LIFO and we're using FIFO, it's really not practical to try to figure that out, so then we can't. Okay, so you don't have to make any adjustments, but you do have to disclose it in the financial statements. Now, a change in estimate, including depreciation, is always done only the future, no restatement, not reported, no journal entry, but you do have to show it as a disclosure note, particularly if it's material. Now, change in reporting entity. This is when we have something that we're treating as on a cost basis, i.e. we own somebody else's stock and we're just treating it as investment, and we now own enough of their stock so that now we have to do consolidated financials. Then we have to go back and restate. And we do have to disclose. And then, of course, errors. Those are all. So change in accounting principle, change in reporting entity, and errors, if they affected prior years, we must make adjustments and disclose it as a footnote. Now, under the international standard, under GAAP, accounting changes and errors. When correcting errors in previously issued financial statement, it is considered practicable to report retroactively, which means they're saying you need to do it. However, under the international standard, they're saying that you don't necessarily have to do that. Now let's take a look at some examples. Now, my corporation changed its inventory method from LIFO to FIFO at the beginning of 2020. So, this is what the inventory is valued at under LIFO. This is what is valued under FIFO, and the difference is $35,000. They had retained earnings of $500,000 at the end of 2020, and the tax rate is 40%. So let's see what information we need. First of all, what kind of change is this and how should it be treated? This is a change in accounting principle causing a retrospective treatment, and we have the information so we can do that. So the journal entry would be an adjustment to inventory, an adjustment to beginning retained earnings net of tax, and we would set up our income tax payable. Now let's look at another example. Change in estimate. Company A purchased equipment for $800,000 at the beginning of 2018, and they were using double declining balance. The equipment had an 8-year life and a residual value of $40,000. At the beginning of 2021, they decided to use straight line, the effects of the change. First of all, we need to determine the double declining balance rate, which is 1/8, because it's 8 years, times 2 gives you 25%. We're then going to determine the accumulated depreciation under each method. Now we have a difference of $177,500. However, the journal entry would be the $800,000 minus the $462,500 that's already been recorded, gives you your net book value, minus our residual value, gives you the balance that can be allocated, and we're going to do it over the remaining life, which is 5 years. So this is going to be our journal entry. Remember, we can't go back and change what we've already done when it is a change in estimate. Now, another example would be warranty. We have a corporation. They have a new product in 2020 that carries a 1-year warranty. It was estimated the warranty expense would be 5% of sales. Sales in 2020 were $3.5 million. Warranty expense was $105,000. Were incurred in 2020 and 2021. It was estimated that warranty expenditures were higher, and the estimate was increased to 7%. Sales were $4 million with actual warranty of $251,000. So, our journal entry. This is a change in accounting estimates, so it's treated prospectively. So, this would have been our first year. We would have booked the estimate, and we would take the actual against it. The second year. Now, what is the estimated warranty liability account? What's the balance in the account? So, it would be beginning, new product. We would do the first year, then we do the second year. So the balance in estimated warranty liability is $99,000. What if instead the company discontinued the new product at the end of 2020? Well, we would have to take out the balance of our warranty, assuming we don't have any more warranty. We would have to then book a loss for the balance, which we're estimating at an additional 2% times the sales. And then that would be cash, would be actually, in reality, that would probably be parts and labor, but we just do cash. That just makes it easier. Now let's look at an accounting change. Joy Company purchased a machine on January 1st, 2017 for $550,000. At that time, it was estimated that the machine would have a 10-year life and no salvage value. On December 31st, the firm's accountant found that the entry for depreciation expense had been omitted in 2018. In addition, management has informed the accountant that the company plans to switch to straight line, starting with 2020. At the present, the company uses sum of the year's digits method for depreciating equipment. I don't know why, just a comment, I don't know why you'd ever use that method because it's just a big pain. But since it's all on the computer, maybe it doesn't matter. So let's see, what type of change do we have here? We have an error and a change in estimate. So, again, the accounting error, failure to record depreciation in 2018. This is a retrospective adjustment. It's called a prior period adjustment. Financials must be restated. Change in estimate, a change in depreciation method is only shown prospectively. It is a change in accounting principle that is treated as a change in accounting estimate. Now, what's our entry to correct the error? So first, we need to determine the factor for sum of the year's digits for 2018. It would be 10 years, so we'd come up with our factor, which is 55. We're in the second year, so it would be 9, because the first year would have been 10 over 55. So we're going to determine the depreciation. The equipment has a 10-year life and no salvage value. So depreciation expense would be $90,000. So the journal entry would be, we would decrease retained earnings and increase accumulated depreciation. Now, determine the entry for the change in depreciation method. Determine the net book value using sum of the year's digits. We'd have our cost less accumulated depreciation for our 3 years. And that would give us our net book value. We have 7 years remaining, so we'd have $40,000. And our December 31st entry would be $40,000. And accumulated depreciation, $40,000. All right. Now, here's a change in estimate. In November 2018, the state of California filed a suit against SAM Corporation seeking penalties and taxes. It's estimated the fines would be between $100,000 and $500,000. According to GAAP, the company accrued $100,000. The rule is, if you have an estimate of a loss and there's a range, under GAAP, you use the low one, which would be 100,000. Under the international standard, you would use the midpoint, which would be 250,000. So this would be the journal entry that you would make. Now, in 2020, the company settled for 450. What type of change? This is a change in estimate requiring prospective treatment. We would take our litigation liability off the books. We would book a loss, and then, of course, we'd pay it. Now, we have one more example. Okay, these are actually a bunch of examples, and it shows how we would fix errors. Now, in 2019, Mike failed to accrue $1,800 in office supplies expense. When they received the bill in 2020, they made the following entry. Now, how do we fix that? We need to take it out of office supplies and instead adjust retained earnings. We don't have to change the cash because we paid the cash. So we only fix what's broke. The other way you could do it would be to reverse that first entry and book it correctly, but we'll do it this way. All right, 2 years earlier, the company issued 4% stock dividend, 2,000 shares with a $1 par. The fair value was $12. The journal entry was retained earnings, common stock. Now, this is what you would do is if it had been a large stock dividend. However, the rule is if it is a small stock dividend, then what we need to do is book it at fair market value, which means that we have to increase additional paid-in capital by the difference. So we're going to take the 12 minus 1 times 2,000 gives us 22,000, would go reduce retained earnings, and we would increase paid-in capital in excess of par common stock. Now, on January 1st of 2020, it was discovered that a $72,000 3-year liability insurance policy purchased on September 31st was expensed. What do we need to do? We need to take it out of retained earnings because in the prior year we overstated our expenses, and so therefore we increase retained earnings, and we have to set it up as an asset called prepaid insurance. And that concludes the presentation for Chapter 20.